You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Okay, well, last week we looked at a calendar trade in Tesla. And I did want to mention this because something happened since we did that trade. They adjusted the anticipated earnings date, and the earnings have definitely changed from the show. I actually did a double check on it. If you, some people still have it back at the end of the month for Tesla. Now we're currently seeing that Tesla is expected to announce earnings on the 7th of February. So I did want to make that distinction that the reason why we set the trade up the way that we did is we thought earnings were going to be at the end of the month, and that date did, and it definitely changed. It changed by a lot. Normally it's a day or two, but now it has totally changed to the 7th, which is actually before the short expiration that we were looking at. Now, there's been some opportunities along the way. Tesla trades all over the place. So you could have gotten out of the trade at a profit anyways, which we kind of talked about doing if we could do that on the way to the first expiration of our short option contract. But when we were looked at the trade last week, it was trading for about $2.30 at the midpoint. Right now, I just pulled up the trade where we're buying the February 23rd expiration and selling the February 9th expiration. The stock is up $8.49 today, and it's trading for $1.35 debit. So what could we do? If we had this paper trade on and we were looking to adjust this position, if you haven't already gotten out of it because it has been profitable, quite profitable at some points in time. The chart on Tesla, let's see if we look at the biggest down day in the last 5 days, is it actually got down to as low as $336. It only 6 points away from our short strike. So in theory, you should have gotten out of the trade. There's no reason to continue in this trade. We don't want to ride it into earnings anyways, but just thought I'd mention that. So if you're going to look to do the trade, what could you do? Well, you could just roll it. You could take it and turn it into the trade that you wanted to do. But if you've waited this long and you didn't get out of the trade, I'd probably just sell it, close it, and go on to the next event, because stuff like that happens. All right. Now, today, big earnings week coming out. We are taping Options Playbook Radio on the 31st of January, and this happens to be the FANG stocks earnings. We got a ton of earnings that are coming our way, and on the 31st of January, the market is closed. Facebook just announced earnings, and they knocked the they knocked the numbers out of the park. At least a lot of people on the big networks are saying that they did. But currently, Facebook is down $8 in the after hours market. And the reason why I bring that up is that we've talked about a lot of speculative strategies on the FANG stocks, which what FANG stands for, in case you didn't know: Facebook, Apple, Netflix, Google. And we've talked about doing a lot of speculative trades. So tomorrow, two of the big ones are Apple and Amazon. And I wanted to talk about protection. Apple got beaten up a little bit because of their sales in the iPhone X or the iPhone 10, and those sales just aren't doing as well, and they announced that, and they already let people know. But they're going to be announcing earnings. So when Apple right now, even though it was trading down all day long, last trade is 167.43, up 46 cents on the day. Going to have earnings tomorrow after the close, and a lot of times people don't like to buy protection on stocks like this. And I sometimes always kind of scratch my head why people wouldn't want to protect themselves on these stocks that have had such big runs up for the year. And Facebook, they're just looking for a reason to try to sell off some of the underlying stock. Now, with that said, Facebook tomorrow could still be up. It's a crazy stock, and it could trade all over the place. You don't know exactly, even though it's down 8 points right at this moment after earnings, you don't know where it might be trading on the open tomorrow. But if you're looking on a stock, let's say a comparative stock, they're fairly close in price, not a couple of 20 points away. Apple's 167. Facebook on the close today was at 186. And just think about buying protection on some of these stocks. And even if you do it once a quarter, it's really not that expensive. And what really helps out in this scenario is the advent of weeklies. Because there's weeklies, there's not a ton of premium in the very short-term option contracts. And we're going to discuss a couple of ways that we can protect these underlyings. Now, we mentioned this a few Option Playbook radios ago, but now we have the timing is right? Earnings is coming out, and I want to look at two different ways that you could protect your Apple stock position. And they're fairly simple strategies, which I don't always get an opportunity to talk about these strategies on Options Playbook Radio. So I'm just talking about a protective put. If you look at Apple right now, the stock is at 167.43. And I look at the long straddle. So the market for the long straddle, the 167.50 straddle, almost exactly at the money, we're looking at buying the call, buying the put. That's trading for $8. Let's call it $8. I'm going to round off. That's a midpoint price, but we're going to round it to $8. So that's the expected move that they're looking for Apple after the earnings announcement. So if you want to protect yourself against that type of move, how about we spend a couple of dollars to try to protect ourselves against an $8 loss? And if the stock goes on up to $8, well, heck, that would have easily paid for any of our protection. So I'm going to look at the small deductible policy, and let's just talk about that one first. So Apple's at 167.50. Let's say we own 100 shares of Apple, and we're going into earnings. We're bullish but nervous on Apple. That's what our market forecast is. That's when you would do a protective put. I currently show the 165 strike put with the February 2nd expiration. So only 2 full trading days until this underlying expires. And I'm showing that trading for about $2.90. All right. So that's protection all the way down to zero, if we want to think of it that way, right? If the market goes below 165 and it went all the way down to zero on Apple, we could take the stock at and put it to somebody at 165. So that's good protection. But now let's look at that on a percentage basis, what we're talking about. So if you're talking about $2.90 on a $167 stock, you're looking at about 1.8% of the total stock price to protect yourself against a stock that has skyrocketed over the last 52 weeks and has had some bad news recently as far as their sales, and they're going to be announcing earnings. Now, if you were always bullish but nervous around all these earnings forecasts and you just bought protection and you just paid 1 to 2%, you would still be doing extremely well because the market has gone up so much. So if you think about it, it's an interesting way to approach some of these FANG stocks that are hard to get into. You say, I'm going to buy Apple, I'm going to buy Facebook, but I'm going to protect myself around major news events. And it honestly is not that expensive to do. Now, if you're not worried about Apple going down 15, 20 points, not saying that that's not possible, but if you're not worried about this most expensive contract, and I should also tell you this though, you're paying that 165 strike. You still have a $2.50 deductible. Before I get ahead of myself here, from 167.50 down to 165, you're not going to have any protection, right? So if the market opened tomorrow at 166, let's call it, 1 point away from our long put that we just bought strike, this isn't going to really help you out very much on that trade. So if Apple doesn't really move after earnings or just kind of slowly goes down, my protection doesn't help. It only helps after I pay my deductible. And that's the way I always think of protective puts, is just like my car insurance. I'm not covered on my car insurance until I meet my deductible. And my deductible on Apple is 2.5 points here. But that's the way that I would look at it, and that's the way I'd approach it. I'm willing to take that risk and then get my costs down to about 1.8%. Now, another way, and a lot of people don't think of it this way, and I've really never even heard this term before, but let's look at doing a long put spread, or instead of a protective put, let's do a protective put spread. And then we're just going to protect ourselves for a range. We're not worried about Apple moving the 15, 20 points to the downside. And once again, this is not meant to be a recommendation. Anything can happen, but we're just trying to learn on Options Playbook Radio. We're just trying to talk about scenarios where sometimes option strategies work out or make sense or could make sense. And so if I'm worried about Apple being wrong, having a bad earnings report, and I know the market thinks that an 8-point move is very feasible, well, let's protect myself as much as I can for those 8 points. So what I can do is, first of all, I'll stay at that 165 strike, right? The market is at 167.43, 8 points, let's call it 160. So I'm going to protect myself from 165 to 160 by using a put spread. And instead of paying $2.90 for my protection, I'm going to sell an option contract and bring in cash to reduce the percentage cost of my insurance policy. All right, trying to use as many insurance terms as possible. So if I do that trade, I still have my deductible of 2.5 points, but I can bring in on that that 160 strike put. And once again, we're still in the February expiration, February 2nd, 2 days away, 2 full days of trading, announcing earnings tomorrow. I can pull in about $1.30 by selling that 160 put. And then my total cost at the midpoint of my put protective spread is $1.59. So now we've gone from approximately 2% of the total stock price as protection down to about 1%. but it's not a full policy. It's only going to protect me if Apple is somewhere between 165 and 160. It will help a little bit if Apple goes to 155. I can still get that $5. The spread should max out and get that maximum potential that it could trade for, which is $5. And don't forget, I also am buying this, and it's 160. So 160 minus $5 gives me $3.40 back to me that I could make on this put spread, no matter how far down Apple goes. All right. So I'm just pointing out the fact with the advent of weeklies, it makes it much more feasible to buy insurance just around an earnings forecast. Now, Amazon's going to be announcing earnings, and I've mentioned this more than once about Amazon and Google, in that with Amazon and Google, we looked at a lot of skip strike butterflies. We looked at volatility spreads, ratio spreads around earnings. And if you go back in the archives, you can see them. And those are speculative trades that I've always liked to do around high price stocks that are going to announce earnings. Now, on Amazon, if we look at the nearest term expiration, it's not a ton of people out there own 100 shares of Amazon. But even if you own 20, 30, 50 shares of it, you can still do a put spread to try to protect you for a certain range. You're just going to get a lot more insurance. You're going to get more coverage for your money because you own 50 shares and the option contracts would represent 100 shares. But Amazon right now is at once again, the close today is the 31st. The markets are closed. Amazon's going to be announcing tomorrow. The most at the money long straddle is trading for about $100. So this market could move $100 in either direction tomorrow. That's what the marketplace is implying that it could do. So would you like to try to protect yourself a little bit on this? And if you did, where would you go? Would you go down 10 points as far as your deductible is concerned on your stock, or would you want to do 15 points, or do you want to do only 5 points? Well, I'm just going to, for the sake of it, I'm going to look at buying the 1,140 strike put and selling the 1,340 strike put. Okay, so now if we did that on our position and we were trying to cover it for just that range. Now you can pick any range that you want to cover yourself in, but the only way on a stock like Amazon to make it reasonable relative to buy some protection is to really spread it off, because you don't need insurance. Most people wouldn't think they need insurance on Amazon for the 1,450 points all the way down to zero. So in this instance, that put spread, and you decide your strikes if you want to or if you don't want to, but you could get a net, you could lower the cost of this put spread down to buying the put outright, which is just $44 straight out on the asking price, or doing the put spread, which would be $6 at the midpoint. Okay, so this Option Playbook radio episode is really just all about protection and thinking about protection around earnings. So $6 on a $1,000, $1,450 stock, right? 1,450 on a percentage basis, that's 0.5% of the actual stock price. So it's just something to think about. And if you do this trade and the market goes up, chalk it up to just insurance, just like you do on your car insurance. You don't buy car insurance and hope that you crash your car. right? And that, I know that's a little bit harder to do in the stock world, but you're buying insurance because you're still bullish on Amazon. You just know that there's a big event that's coming out, and the stock's had a big run up, and it's the same thing with Apple. So let's come back next week and let's look at these trades. If you want to do a more speculative trade, look last month on Amazon and on Google. We did a couple of leveraged ratio spreads in those underlyings around the earnings. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.